for me to even attempt to sort of teach tax law to you in any meaningful way in approximately an hour or so is preposterous. It's just not going to happen because the code, Internal Revenue Code, is big, bad, and ugly in some ways. And so I'm not even going to try to do that. Okay? But what I am going to try to do is point us at some very important aspects or parts of the tax law that we're going to encounter regularly within a VITA program, and even as important, point us to the reference and resources that we have for that. So I think that what we're going to find, I hope, is that less is more for us. If I tried to get down into the weeds, those of you who don't have much tax experience, I'm just going to lose you anyways. And it's not going to be very useful. So we're going to try to keep it high level. We're going to try to keep it kind of moving along. I've got about 5 or 6 aspects that I want to talk about. And then at that point, we're going to turn it to certification. And some of you don't need that because some of you are already certified. And at that point, you would even exit the room. Okay, thank you. So I've got until 11:30 to talk about common situations and an Affordable Care Act overview. And then about 11:30, then I'm available for certification talk. But again, some of you at that point can go find a computer and maybe do a practice return or whatever is appropriate at that time. Okay, what I want to start with then is scope of service. Now, Aaron, I'm sure, has talked to us in a general way about scope of service, or even a very specific way. And one of the keys about scope of service that I'm sure Aaron mentioned, and that is that our liability protections. We're volunteers. Some of us to a larger degree than others, but those of you I'm talking to, almost all of you are pure volunteers. There is no compensation for this. You're doing it out of a spirit of community service. There is protections within federal law in regards to volunteers. Good Samaritan Acts, I think they call them. And that says that if you give it a good, reasonable effort and do it to the best of your abilities and knowledge, you could mess that up and you're not liable. You're not suable for it. A professional tax preparer doesn't have that protection. Okay, they're on the hook for it. There's professional liability. You as volunteers, me as volunteer, I'm an in-betweener. I'm not sure where I fall. We have protection. But that protection, I'm sure Aaron said it, is only available if we stay within scope. We can only do the returns that are within our scope of service and at your certification level. So, within Publication 4012, and my entire presentation up to the time that 11:30 comes around is based on Publication 4012. So if you've got a 4012, that's where I'm coming from. I think everything I'm doing, yeah.
If you have a red binder, you have Publication 4012.
There we go. No, that's right. Near the front of 4012, there's a section, and I think it's just in the introductory section, Scope of Service. And so we see here a list, which frankly, guys, is sometimes not a satisfying list, because it doesn't give us sometimes the detail we want, but nonetheless, it's what we've got. And this shows us what is in scope for basic certified preparers and what is in scope for advanced. And I'm not going through every one of them. I'm just pointing us to that as a resource, as a place to look when we are answering the question, is it within scope of service? Now, it's not a comprehensive list that's going to answer every situation. And we've even got some situations that we can, in a sense, say unilaterally that that we've been given the option of considering things out of scope, and sometimes we do, in fact, as a program, consider it out of scope. One of the places I want to start with, pointing at specifically, even though I'm not going through every one, is married filing separate. Married filing separate we do not do at our VITA sites. And the reason for that is Wisconsin's marital property laws. Wisconsin's marital property laws makes married filing separate a complex area of taxation beyond our scope. When I was in the tax business, it was a matter of a client sitting down in front of you, and if the first words out of their mouth were, "I got divorced last year," you wanted to find a hole to crawl into. But you couldn't. You couldn't. Here, we can just say, "I'm sorry, that is not within our scope of service," because it truly is a lot of complexity to it because of the splitting of income while people are married under our marital property laws, which are essentially community property rules. Okay, so again, not going to go through every one. I'm going to kind of take advantage of this and not spend a whole lot of time there. But there it is, publication 4012 in the beginning. That should answer whether or not you can do that tax return, or at least give you a very good lead-in to whether or not you can prepare that tax return. Going to the extender page, in fact, I think it's a tab, the extender tab within your red binder. Legislative extenders. We had just a few weeks ago really the most substantial extender legislation that has gone through Congress in a long time. And what extenders are is that Congress, a lot of times for budget scoring reasons, will say that this provision of the tax code only will last until, let's say, December 31st of 2014, or will only last until December 31st of 2015. Now, if you go into the private conversations among the legislative staff or the members of Congress themselves, what you'd find is that everyone in that room knows that Congress will extend that. But for technical budget reasons within the U.S. government, the legislative governmental rules that are followed by Washington, sometimes they'll say it's only going to last for a year because it doesn't have as bad of an impact on the budget. So Congress every year shows up and extends certain things. Well, luckily, they did a big extender package this time. And number one, made some things permanently extended, kind of took them off that list of things that need to be extended. But then some of them they extended for a couple of years, so we don't need to kind of deal with it next year. But that was around Christmas, if you were kind of following the news in that way. And it's after this book was published, the 4012. So I'm about to give you a verbal rendition for this list here of our situation with extenders. Educator expenses. These are our school teachers, kindergarten through high school, that many times they need to go out and buy supplies and certain items for their classrooms out of their own nickel. You know, they have to do it out of their personal funds. Well, Congress gives them an above the line, meaning a deduction for AGI, meaning that you can take it on the first page at 1040 is what that means. You don't have to itemize to take it. So an above the line deduction of up to $250, that was extended permanently. That's been extended a bunch of times over the years. Now it's permanent. So it's kind of off the table. Tuition and fees. We are almost always in a VITA program. If someone has education expenses, we are almost always going to take a credit for those, which I'll talk about later this morning. We will almost always take a credit for these. But certain people, and really for our clientele, very few or maybe none, would be better off if we took a deduction for those education expenses as opposed to using a credit. So what I'm saying is, I don't think you're going to be using tuition and fees because I think you're going to be better off and you're going to help your client more using a credit. But if you happen to, that was extended through 2016. 2016. So that means 2 tax seasons we get it for, because we're doing the returns ended December 31, 2015, right? And then it's going to extend through December 31, 2016, meaning this tax season and next tax season, it's good to go. State and local general sales tax, permanent. State and local general sales tax, permanent. Now, what that, and by the way, we would have been okay if I wouldn't have answered that, because what state and local general sales tax is that on Schedule A, which is itemized deductions, medical, real estate taxes, income taxes, mortgage interest, contributions, right? That list. Within itemized deduction, we have a tax section. You can either take the income tax that they paid to state or local, and for us state, because we don't have local income taxes here in Wisconsin. You can either take state income tax or general sales tax. And of course, we have both, don't we? We see it every day we buy something, sales tax. But in Wisconsin, we almost find that the income tax is much larger than the sales tax. So in Wisconsin, we're probably, and I'm just grabbing a number, I've never analyzed this or read it, but I would say 96 out of 100 times when a Wisconsin tax filer itemizes deduction, they take state income tax. Texas, no state income tax. They're all taking the sales tax. Okay, so for us, it's the exception to the rule, big time the exception. In other states, it's the other way around, but that's extended permanently. Mortgage insurance premiums. PMI insurance, right? Somebody buys a house and they don't have 20% to put down on the loan. The lender will require that they pay for an insurance policy, which helps protect the lender. Private mortgage insurance. For almost my entire career in taxes, private mortgage insurance was just an item that they had to pay for, but there was no tax ramification to it at all. But then about 10 years ago, private mortgage insurance, or what they would call here mortgage insurance premiums, became associated and treated just like mortgage interest. And that, like I say, it wasn't there forever, but then it came in about 10 years ago, but then it was part of this extender nonsense. Okay? And so that was extended, and that's through 2016. So if somebody has private mortgage insurance, that becomes a deductible item, but you're probably going to see it on their Form 1098 anyways, which is the form that people bring in to say, I paid home mortgage interest, because there's a box for it. But you know what? It's interesting. I'm not sure be interesting to see what the reporters in the world do if they didn't have to, because of the possibility that wasn't going to be extended. But I think it'll be there. Residential energy credits. They bought a new energy efficient furnace. They did insulating on their home. Certain things can generate a credit because they purchased or upgraded their home for energy efficient purpose. That is, we call those in general the residential energy credits, and frankly it's really a complicated area because of the way they word it. They word it awful, I think. Always a little bit hard to know where we stand with it. But nonetheless, those kinds of credits, they bought a new energy efficient water heater, furnace. They've insulated their windows. They got new windows which met energy efficiency standards, etc., etc. Extended through 2016. Now there's a box on our intake form. What's the number again?
13614C.
13614C. There's a box there, and so if they check it, then you kind of look into the details of it. I think that's kind of the way we would go. We would probably see that being used not much. Well, our clientele would by and large be renters. Cancellation of debt, principal residence. And I'm going to go beyond just speaking about that. And again, there's all levels of tax knowledge in the room here. If I have a credit card and I get behind on my credit card and it got to the point where I'll never be able to repay it, and I work out an arrangement with the credit card company where they cancel some of my credit card debt. You know, I'm broke and I got a bunch of credit card debt. And they realize that, and they say, you know, well, let's work something out. If we cancel it, will you make payments of $400 a month or whatever it works out to? But we often see, that is not unusual for us, to have a client walking in with a form called 1099-C, C like cancellation. And almost always with our clients, it's going to be representative of debt cancellation. The significance is debt cancellation is in general taxable income. And sort of it's like, you know, somebody who's already struggling, here's another piece of good news for you, right? You got the debt canceled and then they visit us and it comes back again to them. The bad news comes back. Congress, during kind of the Great Recession, shortly thereafter, passed legislation which enabled the cancellation of debt on someone's principal home, you know, all the foreclosures and bad houses underwater and all that, right? Passed legislation which said that the cancellation of debt for principal residents in general, it's, you know, there's complexity to it, but in general, cancellation of debt in regards to principal residents is not taxable. You know, that piece of bad news we wouldn't have to deliver. So I say two things here, and that was, by the way, that's through 2016. But my message is this. Number one, be aware that cancellation of debt is taxable income unless we can find an exception. And that relates to property like a home, or, again, to our clients, a lot of times it's going to be credit card debt that's canceled. And then secondly, that specifically the principal residence exclusion was in fact extended. Okay. Questions, concerns so far? Okay. Continuing. Affordable Care Act. I'm gonna to some degree I'm gonna soapbox a little bit at first, and that is that we at VITA, in terms of Obamacare, when we're VITA volunteers, we are not political. The clients can have political opinions. We don't share them. We don't share them. Okay, because that is a road that that is just not going to end in a good place for us. Okay, so someone's opinion about whether it's good legislation or bad legislation, we respect their opinion, but let's not encourage it. Okay. All right. The Affordable Care Act in general, Obamacare, tax provisions in general, and if you wouldn't mind, just some notes. I've just got some brief comments. The biggest picture I can draw as far as how the Affordable Care Act impacts us as tax preparers, as people who assist people in preparing their taxes. First of all, Affordable Care Act reforms the insurance market by prohibiting denials for pre-existing conditions. One of the headlines of Affordable Care Act. Prohibits denials for pre-existing conditions. And another headline, creates a health insurance marketplace. Now, if I understand right, correct me, Aaron. I bet you would. I bet you're on top of this. The health insurance marketplace is either the federal marketplace for states who did not opt in, or state marketplaces for those states that did opt in. But one way or another, every citizen has access to a marketplace. In a state that adopted, kind of their homegrown marketplace. For states who didn't adopt, federal marketplace. Am I doing okay? So that's the second headline, created marketplace. The marketplace is a place to find information regarding plans. It's a place to purchase health insurance. And if eligible, it's a place where people can get premium reductions through. Specifically tax related. The two Roman numerals, Roman 1 and Roman 2. Roman 1 is premium tax credit. Premium tax credit. A credit that people can get to help them pay their health insurance. It's either taken by a premium reduction up front or on the tax return, or really a combination of the two in almost every case. Because we sort of use the tax return to reconcile. If they did get assistance, we reconcile whether they got too much or too little assistance. We're kind of the final stop. The assistance that someone would get where their premiums are reduced is just an estimate of what they're entitled to based on an estimate of what their income's going to be. You know, they could have been way off on their income. Comes down to us to reconcile it, which is really not a very happy job, usually. Because I think a lot of times they overestimate how poor they're going to be. And they get more premium reduction than they're really entitled to, and they come to us and we tell them, you're going to owe a little bit back here. That's not a great role for us, but that is the role we have. So that's Roman 1, is there's a premium tax credit. Roman 2, and when I say Roman, Roman numeral 2, right? I've got an outline, right, in my mind. Roman 2 is shared responsibility payment. You did not have health insurance. You were supposed to have health insurance. You do not have any exemption from getting health insurance. We're going to penalize you. We're going to penalize you. It's a sticks and carrots, right? Premium tax credit, a carrot. Shared responsibility, stick. Everybody, unless they've got an exemption, should get health insurance in this country. And if they don't, there's a penalty on the tax return, the shared responsibility payment. Okay? So 2 big items on the tax return. Now, the good news, in one of these I'll say 2 things. One of them I wouldn't have said a year ago. The good news is most people either have an exemption or they have insurance. And a lot of times on a return, it's a nothing. You know, me and Kathy, our joint return, I work at Midstate. They treat me very well, and I have health insurance through Midstate. And enough income that I'm not entitled to any sort of credit. Well, I don't get it through the marketplace anyway. But nonetheless, for Kathy and I, and for many of you, you check a box and that's it. That's the Affordable Care Act. Check a box. That's most people. And the good news is that a year ago, we were afraid of this thing. It wasn't bad. It wasn't bad. We got through it pretty well. Okay, so a couple of specifics here. I talked about the fact that we all need to have insurance unless we have an exemption. And if we don't have insurance and don't have an exemption, stick. Shared responsibility payment. But a lot of clients either have insurance or have an exemption, guys. We're not going to be using the stick a lot. But that's how we get to the stick. Did you have insurance all year? Yes, I did. No stick. Did you have insurance all year? No, I didn't. Exemption? Yes. No stick. Did you have insurance all year? No, I didn't. Do you have an exemption? No, I didn't. Stick.
Do they need to provide any kind of proof saying that they had it, or is them telling us they did just?
No, we are told in our documentation specifically that verbal is okay with us.
Unless it's through the marketplace.
Unless it's through the marketplace, which means that they need to actually bring in a code to us.
Okay.
Yeah. Thank you, Aaron. Good add on there. Okay, exemptions. Does anyone have an exemption from the marketplace? And that's a specific exemption certificate number. We can't create it. And we're not going to try. If they think that they are entitled to exemption from the marketplace, they have to go to the marketplace and bring it back to us. We're not in the marketplace exemption business. That's my opinion. That's a 45-minute swamp that we can't go to because we got an appointment at 10. Right? We can't go there with them. So they go to their private accountant. Maybe that private accountant's going to spend 45 minutes and bill them. We can't. So if that's the case, then they've got to go back to marketplace and then come visit us again. Number 2. Let's see here. Where does it? Well, it really doesn't take us to the next step. But nonetheless, is household or gross income under the filing threshold? And that's really kind of a wacky question in a way, because household income and gross income are very often different numbers. They don't mean the same thing. Now, there can be very simple households where they are the same number, the same amount. It doesn't always have to be different, but they're often different. And we'll look at that in a minute. I think, let me make sure. Yeah, we'll look at that a little more specifically. But the filing threshold is what's considered when do you have to file a tax return. That's what filing threshold means. If the family does not qualify for exemption under 2, does any individual qualify for an exemption that can be claimed directly on the return? And we'll clarify that in a moment. And then number 4, for any uninsured that does not qualify under step 2 or 3, does any individual qualify from an exemption from the marketplace? If yes, direct the person to the marketplace. Again, we kind of politely but firmly kind of move them to the marketplace for answers. Okay, here are the exemptions. And by the way, again, guys, this is all out of your red folder. So nothing that I'm going to show you today is not right at your fingertips. Income below threshold. But take a note here. Certain of these are granted by the marketplace. Nearly all are claimed on the tax return. And some of them are both granted and claimed. And some of them are granted down at the bottom here, but not claimed on the tax return. And that's where, I suppose that's where, what is ECN? That's an exemption? That's a certificate number? Okay. Now, the ones that, and I'm not going to go detail, and I'm going to have disclosure here to you guys. And that is that I haven't been a full-time tax preparer for a few years now. I've been teaching for 6 years. And I don't spend my time like I used to day after day after day after day doing tax returns, which I did for like 30 years. But it's been a while. So some of these, I'm not going to stand up here and say, well, we're going to do a big overview, and then have you think that I know every detail of this, because I don't. I don't. If I would still be in the business, I think I would. But my role does not require that I have the kind of detail in tax law that I used to. And this came about after I sold my business. So some of it's a little spooky to me too. Income below the threshold. Now we'll look at that in just a minute, what that means more specifically. Coverage considered unaffordable, and there are worksheets that can be used to make that determination. Now that unfortunately is kind of a challenge for us, and I think that it would be appropriate for us to take that time, even though that might mess up a bit of a schedule someday, because it's important for our clients, it's important for their economic prospects that we do this, but there are worksheets right within your red folder to kind of help you through that. Short coverage gap. If they didn't have insurance, but it is, what's the wording there, less than 3 consecutive months, they kind of get out of jail free card for that. That they're not going to get slapped for that one. That's just considered temporary, and it was solved, and they're okay. Okay. Now, those are the 3 I wanted to focus on for this list. I'm not going to go through this list. In fact, I've got 25 minutes left, and I've still got quite a bit to talk about, so I need to move along here. Here is the household income part of it, which this will be the sort of thing that I think we would, if we're going to encounter, this is pretty close to the one we will encounter, I think. And it's very weird, and as somebody who self-professed, like I said last week, a tax nerd, and I'm very much proudly wear that label, this is real interesting stuff to me, because notice what household income is. It's modified adjusted gross income. And modified adjusted gross income means their adjusted gross income. Now, that doesn't mean their total income, because adjusted gross income is their total income minus things like moving expenses, or IRA deduction, or self-employed retirement plans, or alimony paid. There's a whole list. It's right down at the bottom of Form 1040. Those are what I've always called adjustments. That's the way I learned them years ago. We could call them above-the-line deductions also. But adjusted gross income is that bottom line number on Form 1040. It's after all of those above-the-line deductions have been considered. And then we add back to that tax-exempt interest, if they have a tax-exempt interest, like municipal bond interest. It's not subject to federal tax. And then perhaps we're going to add in excluded foreign income. We don't see much of that. That's when somebody works overseas and they're able to exclude their earnings from working overseas for U.S. tax purposes. Really a sweet possibility for those people who do in fact work overseas. But nonetheless, we could go months without seeing one of those at a VITA site. Okay, but that's what household income is. And household income, then, we compare it against the filing requirements, the filing thresholds. The second way that we can meet this exemption is to find gross income. Now, gross income is their income subject to tax, but without any of those deductions that I talked about, without alimony paid, without moving expense, without IRA deduction. It's just kind of the pure income that's subject to tax. Okay? And then we would take that number and compare it against the filing requirements. So in other words, we've got 2 shots at it. We can meet it through the modified or the household income part, and if we meet it there, done deal. We don't have to, all we need to do is get lucky once. But if we don't meet it through the household income, then let's take a shot at it through gross income. If we get it either way, they're exempt. And they don't have to pay a shared responsibility payment. That's what this is all about. These are folks who don't have insurance. Oh, you don't have insurance. You might be subject to shared responsibility payment. Let's see if we can get you out of it. Let's look at some exemptions. And this would be one of those exemptions to get them out of it. Okay? and not get them out in a bad way, get them out entirely legally and appropriately. Real quickly, and I've got to move quickly, another one is another exemption that we might be able to deal with internally, so to speak, and at that moment, is the unaffordable exemption. And just note that we have affordability worksheets available to us to help us work through these items. Okay? And so, and I'm saying we can't ignore all the other ones, but I'd say that our greatest hits as far as exemption is the filing threshold and the unaffordable. Those would be the ones we would probably feel most comfortable going to. And I think I'm just guessing without any analysis, the ones that probably are going to be most meaningful to our client base. Okay. And then real quick again, and that is premium tax credit. Remember this, premium tax credit is basically based on two items. One is that they purchase through the marketplace. That's an absolute. You know, let's say that Mid-State wasn't as good to me as they are, and my income's quite low, okay? But Mid-State did provide me with health insurance. I am not a candidate for the premium tax credit because I get employer-provided insurance. Only people who get through the marketplace are premium tax credit people, and they should bring in a 1095A. Am I right on that one? 1095A. So 1095A, a form that they bring in and put on our desk, right? They bring us W-2s and they put it on our desk, right? They're going to bring us a 1095A or multiple 1095As, put it on our desk. That's when we basically kick into premium tax credit gear. They may or may not get it based on their income, but the 1095A keys us or kind of jumpstarts us. Oh boy, I'm in premium tax credit land. And I don't say that in a scary way. It's just another credit. It's not that tough to deal with. Okay, that is my 20-minute version of the Affordable Care Act.
I just want to add one thing. If you're looking at page ACA 15, you'll see that there's the 3 columns on that 1095A. And if you flip to the second page, you can actually see where the information gets entered into Form 8962. One of the mistakes that I saw most frequently last year is that column A on the 1095 corresponds to column A on 8962. Same with column B. Column C on Form 1095A gets entered on column F. And it's the TaxWise software is set up so that you're not supposed to be able to enter anything in column C. But because we have that override function, some tax preparers got a little bit antsy and thought, well, C should be transferred to C, and that actually resulted in errors. We caught them, but I'm just telling you that, you know, as you're working through this, the information's right here. It tells you what column to enter it in. So follow these instructions. Try not to be smarter than the software. There are some things that it's set up to make your job a little easier, but be attentive to that.
And, you know, I'm gonna follow up with that, just saying that any override, really, you better take a breath, make sure you've got a darn good reason and you know what the result of it's going to be, because we've got to assume that tax-wise, the programmers know what they're doing. And we should only use overrides if we're confident and we know what the result's going to be. Don't do them lightly, because a lot of times you, in fact, are going to be the one that's wrong, and tax-wise it's going to be right. There's a tab for filing status. And filing status is one of those really sort of, it's like job one for us as VITA volunteers. You could easily go a shift without seeing Affordable Care Act that you have to encounter. You could go a tax season easily without having cancellation of debt. As you know, every tax return filing status. Some of them slam dunks, right? My wife and I walk in and we want you to do our return, married filing joint. Don't need a class, don't need me, don't need a book, it's married filing joint. We have a 23-year-old, unmarried, never been married, and never fathered or gave birth to a child, right? And lives entirely alone and has really just is really an independent unit. Single. Don't need me for that. Okay? But everything in between, not so much you need me, but you need guidance if you're not highly experienced at this. This is 30 some years for me in some sort of gig related to this stuff. I use this stuff nearly every time because there's a lot, there's complexity, there's subtleties to it that we can't just sort of make snap judgments about. Believe me, you can't. You're going to be wrong a good number of times if you are overconfident in this area. But this decision tree is beautiful, just beautiful. It'll walk you right to the filing status if it's read closely. Don't ignore the footnotes. The subtlety, there's a lot of the subtlety down in those footnotes. Okay. All right, now, so decision tree, our friend, Invita, and really any tax preparer. Now, one other thing I wanted to point out was qualifying persons for head of household. If you've got a couple, and let's not even have kids involved. You've got a couple cohabitating, right? And one of them graduated from college 2 years ago and has a good job. The other one is still in school. You say to them, are either one of you head of household? Well, that one that's got the job might say, I am. Because that's probably the way it feels to them. And I wouldn't disagree with that. But when we get to filing status, no way, no how are they head of household. They're single. They're single. Because only certain people qualify another person to be considered head of household. The kids, yes. Almost always. We've got to be a little careful here if they're married. But if they're living with them and they're young enough and they are in fact their children, yeah, the kids, no worries. Mom and dad, the parents, yeah, they work, and they work even if they don't live together, which is kind of an exception for parents. I mean, you could be keeping up your parents' house, and they could live in another state or across town, and you could be head of household because of your parents, even though you don't live with them. But then also we've got qualifying relative, and look at the list here. Son, daughter. These aren't qualifying children. Son, daughter, half brother, half sister, an ancestor or sibling of your mother or father, right? Your grandparents, certainly. But notice the wording there. A sibling of your mother or father. Right? We've all got, I assume, aunts and uncles. Most of us do. And one of those aunts or uncles are our parents' brother or sister. But the other one is Aunt Mary because she happened to marry the brother or sister, right? We call them Uncle John and Aunt Mary, don't we? But only Uncle John qualifies. Aunt Mary doesn't, because that's not a sort of a, well, I won't even say blood, because that would be oversimplifying it. But you know what I mean? They became aunt by marriage. That's not working. So I won't go through every one of these. Just know that they need to be here. If there's any question, if it's single mom with 2 8 and 10-year-olds, you know what I mean? 1 8, 1 10. You don't have to go to a chart. They're okay. But the other one's not. And certainly the boyfriend, girlfriend. And by the way, fiancé is a meaningless term in our world. Fiancé means nothing to us. They might as well say somebody I met yesterday. Okay? There's no legal standing to it. Now, but some people And well, I'm going to go a little long here, sometimes I can't help myself. But fiance doesn't mean anything. But we also have to be careful for those folks who purport or explain themselves to the world as being married, but they're not. They've been together for 12 years, and it's easier for them to go around the world and saying, my wife, my husband, they're not married. Again, they might as well met yesterday. We are not a common law state. South Carolina, you shack up, married. Wisconsin, you shack up, you're buddies. Okay? We're not a common law state, so don't let people take you there because they'll want to take you there. They'll want to take you there because it's just a better story, so to speak. And I'm not trying to be cynical, but we've got a filing status to check, right?
How are we treating like domestic partnerships and civil unions in Wisconsin this year?
Let's see. If I'm thinking. I wish I would have thought of that this morning, Laura, because I needed to refresh myself. But in Wisconsin, now we need to recognize same-sex marriage. Is that right? And so domestic partnership is not. Oh gosh.
It's on
I had
page
it last year, and I haven't thought about it for a year.
Nope. So the page B2, it's the very first question. So it identifies answer no for individuals who have entered into a registered domestic partnership, civil union, or other similar relationship that is not called a marriage under state law. So marriage is marriage, and anything else is not.
Okay, so we are recognizing same-sex marriage as marriage.
Yes.
Right. Yeah.
But for those folks that have 20 years living together and say, call my wife and my husband, we request the marriage certificate or?
Well, no, we really just ask them, are you legally married? They know.
Oh, okay.
They know. But they just need to be pressed a little bit. Dependents. Again, these are all tabs within our red books. 9 minutes left. Dependency. If you've been around a while, you grew up in a tax world where there were dependents and not dependents. There weren't many layers to it. And what made someone a dependent was that you provided over half of their support. That was one of the key factors. Wasn't the only one, but it was a key factor. And many of us in this room and many people in this world, including in the tax preparation industry, still stick with that notion. Because it was embedded sort of in our culture. But really now, I bet probably getting on 15 years ago at this point. The rules changed dramatically for dependent exemptions, and we got the new categories of qualifying child and qualifying relative. That's how we define dependency now. Are they a qualifying child? If not, are they a qualifying relative? If not, they're not a dependent. Qualifying child essentially means that they are the taxpayer's child or even brother, sister. We've got kind of a broad definition of child, meaning that they meet the relationship test. They're related in a way that is appropriate. The relationship. That doesn't mean they're a distant aunt. That means they're essentially a child of the taxpayer, but defined broadly. Residency. They lived with them over half the year. And age. They're either under 19 or under 24 and a full-time student, which, by the way, is only part of 5 months of the year. That doesn't mean a full-year student all year. It means full-year student for part of the year is what it means. or that they're disabled. Totally and permanently. So qualifying child with some other things, age, relationship, residence, they meet it. They're young, they live with them, and they're their kids in a sloppy, offhand way. And also that the child themselves does not provide over half of their own support. For qualifying children, whether the parents are providing over half their support is not part of the equation. We can get to children of divorced or separated parents, but nonetheless, it's a very different rule. And I'm just saying that because, you know what, I think there's some new volunteers with us, and they probably kind of came of age at a time where the rules were different, and I'm just trying to point out that it's a new dependent world out there now. If they're not a qualifying child, then we look and see whether they're qualifying relative. But we always start with qualifying child if it's, if it's their mother, their 68-year-old mother, we're not going to do that. But by and large with kids, we start with qualifying child because it's better. I mean, it's much more valuable to be qualifying child than qualifying relative, because qualifying child kind of opens up Pandora's box of tax benefits. Qualifying relative, you get the dependent exemption on the return, and that's great, but it's nothing to write home about. So we start at qualifying child, we go to qualifying relative. Table 1 takes us through qualifying child rules. Table 2 takes us through qualifying relative. So again, table 1, and if that doesn't work, then go to table 2. And again, you can skip table 1 if they're, the 68-year-old mom or the 42-year-old brother or even the 30-year-old friend or live-in. I was kind of hard on the live-ins with filing status, but no, I mean, the live-in could be a dependent. That college student who's living with the one who graduated 2 years ago and has a good job, that college student could be a dependent of them. Okay. Children of divorced or separated parents have special rules. Now, one of the things that we run into trouble with, and any tax preparer in this country is going to run into trouble with, is that if we're doing a return for a non-custodial parent, they might be able to claim the children as dependents. I mean, really, the custodial parent is the one who kind of rules the roost as far as dependents go. But that custodial parent could give the non-custodial the right. But we need a Form 8332. You're going to find clients, non-custodials, who come marching in with a divorce decree. Now, that divorce decree is okay if it was executed after 1984 and before 2009. Then a divorce decree does in fact work, or could work, if they've got the necessary information. Okay. I mean, if they've got enough of the decree. But somebody divorced 5 years ago, last year, divorce decree, as far as claim independence, is useless to us. We need that actual IRS Form 8332 signed, or a document that's got exactly the same information that it does. And that is, at one of Aaron's sites this year, that will be a problem several times, I guarantee it. The non-custodial, usually father, is going to come marching in with a divorce decree from last year, and it says I get to claim my kids as a dependent. And that's because they had a sloppy attorney who even put that language in the decree. And we're going to tell them it's not of any use to us. We need the form signed. I don't want to deal with her. Right? Or she won't sign that because maybe he's behind on child support. Sorry. The world, again, some of you guys grew up in a tax world that's different than this. The decrees used to work. They don't work anymore. Unless, they've been divorced quite a while. We need that form signed. Okay, now, And I am running out of time here, but darn, not my fault. Qualifying child of more than one person. We've got grandma in the house. We've got mom in the house. We've got baby in the house. Okay? And we might even have grandpa in the house. Or uncle in the house. Grandma looks at that baby and says, that's my qualifying child. Because the baby meets the age relationship residence test and the baby doesn't provide over half their support. Grandma looks at baby and says, my qualifying child. Mom looks at baby, my qualifying child. Not even, I'd have to look, but I think uncle could look and say, my qualifying child. Might be wrong on that. But definitely grandma and mom can. Only one of them can claim. Usually they can decide among themselves, but we recently had, and when I say recent, last couple of years, a clarification of that if mother's AGI is higher, in fact, if grandma's AGI is higher, then grandma can claim the kids, but otherwise not. My point is this. There are situations where a child has more than one person out there who consider that child qualifying child appropriately, but only one can claim. Usually it's a matter of them making a choice. And these rules here only come into play when, in fact, more than one do claim. And there's a conflict. And they've got to sort it out. Okay? But usually, in most cases, considering this wording down here, so, we've got to really remember this wording in regards to the AGI of the parent. But usually they can make a choice. And here's the classic example. In fact, even a better example. Cohabitation. They are both the natural parents of the child. They're not married. Those children of that relationship are and they're living together. Those children are qualifying children of both the dad and the mom. And they've got to make a choice. Who's going to claim? Only one of them can claim. And if they just decide among themselves, you do it, that's fine. We're fine with that. If there's two kids, you take him, I'll take her. That's fine. As long as we don't have more than one tax return claiming that kid. Okay? But let's say that they lived together all year and they broke up in January. They broke up today. They come to us in 2 weeks. They're broke up. Okay? They're not talking to each other. And we're doing mom's return. She says, I want to take my kids. Across town, dad's getting his return done. I want to take my kids. They both claim the kids. First of all, it's going to cause an IRS reject for whoever claimed last. Sometimes it's a race to it. But it's not really a race. Because these rules come in to decide who's going to win the fight. Who's going to win the fight? These rules don't determine who's going to claim because, again, taxpayers can make choices. You take her, I'll take him. That's okay. That's okay. It's only when they both claim we go to these rules to sort it out. And really, we don't go to the rules, basically. We might, but a lot of times it's in an IRS office that they go to the rules and they award the winner. The winner is. And that's what the tiebreaker rules are. Okay. I'm going to do it quick. Earned income credit. First of all, here's the income for earned income credit. Look at, those are decent sized numbers, aren't they? Okay. So lots of our clients are going to be eligible for earned income credit. There's two ways to get earned income credit. One is if you have a qualifying child, and basically it follows the rules for dependency. Basically, there's some subtle differences. But by and large, the rules for dependency work for earned income credit, with some differences. But then there's also people who don't have a qualifying child, that can claim it. It's much less valuable, and it's fairly restricted here. I mean, they've got to be at least 25. They've got to be less than 65. And really the income range is fairly narrow, so we don't see a whole lot of that. We're going to see much more of this, but I would suggest that every time you've got someone who gets earned income credit, you see it calculated, I would turn to this page and just do a review of it and make sure yourself, yes, 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 they're entitled to it. Don't let that return out until you've done maybe a self-review of your work to make sure that they are in fact entitled. I talked about it last week, I think, and that is that these things can be $4,000, $5,000 if we get if we get Wisconsin included, maybe $6,000. I mean, they can be immense, and we're talking about people whose income for the year could be $16,000, $18,000, $20,000 a year. Imagine, think of your income. Think of a bill arriving for 1/4 of your yearly income. It's like a bomb went off in your financial life. We do not want to give this credit to anybody who's not entitled, and we very much want to give it to those who are entitled. But it's up to us, and this chart can be a great help to us. Don't ignore this chart. Go to it and say, yep, 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 yep. It won't take long at all. Won't take long at all.